So what's days sales outstanding? What is DSO? Listen, you may or may not know this term, but I guarantee you your CFO absolutely knows this KPI and is paying attention to it. Days sales outstanding is look, guys, it's very simple. We don't have to make it too complicated. It's just basically, look, how quickly are you collecting cash? How quickly are you taking an invoice and turning it into cash? The actual definition for it is, look, days sales outstanding is a measurement of average numbers of days that it takes a company to collect payment after a sale has been made. DSO is often determined on a monthly, quarterly, or annual basis. All depends on your business, all depends on your CFO, ownership, what they're trying to measure. It can be calculated by dividing the amount of accounts receivable during any given period by the total value of credit sales during the same period. And then what you basically do is you multiply that result of that equation by the number of days in the period that you're trying to measure. And that's how you basically get it. So let's just say company A is trying to measure their DSO in July. Let's just say that they did a total of $500,000 in credit sales, right? So they basically sold $500,000 on credit. So cash didn't come in yet. But at the end of July, all they had on the receivables from that $500,000 was, let's just say, $250,000 on their books, which means that the other $250,000 has been collected. So in July, there's 31 days. So let's just say company DSO for July, let's just say they want to calculate this. So they would go $250,000, which is the accounts receivable left over on the books, divided by $500,000, which is the total sales that were made in July. Then they would multiply that by 31 days, which is, of course, how many days are in the month, and it would produce a 15.5 days sales outstanding, which means that on average in July, it took them about 15.5 days to convert a receivable into cash. Look, it doesn't matter what business you're in. It doesn't matter what industry you're in. The goal is always to accept and collect the cash as quickly as possible. Every business that extends credit wants to turn an invoice into cash as soon as they possibly can. So dropping those DSO numbers are important. So just to conclude this, right, just so you guys get it, let's just make it in simplest terms, take all the equations, all that stuff out of it. It's just simply this. How fast are you transforming an invoice into cash? That's what DSO is.